My name is Maria Demergis. Oh, can you hear me? Yeah. So welcome again to this today's event, which is of course to be discussing the issues that you and I will talk about: inflation, the war in Ukraine, uncertainties, and how ECB is preparing to deal with these incredible uncertainties that we are facing. So what we're going to do today is Philip will give us a short presentation with the latest of the numbers and his thinking of ECB policy, and then we will open up the floor for discussions with both our audience, physical audience, as well as the audience which is on questions that you can pose on Slido. The code for the Slido questions is Euro, so please do type your questions. I will be monitoring, trying to feed them into the discussion. And with that, without further ado, Philip, the floor is yours.
Thank you, Maria, and thank you for hosting this event. I'm assuming the slides will be visible on screen. Is that fair?
Yeah. Can we please have the slides on?
Okay, very good. So I decided to organize these opening remarks basically on this topic of when we think about the euro area outlook for the economy, for inflation, what are the main analytical considerations that we need to think about? And essentially, we are focusing on three themes which are interlocking. The pandemic itself remains a first-order driving force. Over the winter, so the last weeks of 21, the early weeks of 22, pandemic restrictions were still inhibiting economic activity in the euro area. Now, these restrictions are currently being lifted, and that's going to add momentum to the reopening of the European economy. But we also know that the current restrictions in China is contributing to a further wave of bottlenecks in global supply chains and limiting domestic demand in a major region of the world economy. So, as indicated, the reopening of the European economy should add momentum, and let me highlight in particular that the prospect of a more normal summer tourist season should be especially important for the services sectors and the tourist-intensive countries. So that's the first force, the pandemic. Second, we have the significant jump in energy prices since the summer of 21. And this has to be considered a major macroeconomic shock. Now, in the particular case of the euro area, it's important to recognize that oil and gas are primarily imported, so that this is a major terms of trade shock, reducing the aggregate real income of the euro area. Now, when you have an adverse terms of trade shock, we have the implications of lower real income for basic cash flow reasons, for consumption and for investment. And also we have to take into account that a persistent increase in energy prices may reduce aggregate supply capacity by making it uneconomic to operate energy-intensive production technologies at full capacity in some industries. This is especially relevant to the tradable sector, since it's also true that the relative price of energy has gone up by more in the euro area than it has in other parts of the world. So there's a relative cost differential that's relevant there. Now, in terms of inflation dynamics, even if a rise in energy prices is ultimately a level effect, a protracted phase of temporarily high inflation does run the risk of affecting medium-term inflation dynamics through a resetting of inflation expectations. And that topic I'll come back to in a few minutes. And of course, the third force is the Russian invasion of Ukraine, which is a watershed for Europe. The economic impact of the war is operating through several mechanisms, including the amplification of the energy shock, contributing to a new set of bottlenecks, and downward revisions in consumer and business confidence. Now, of course, those channels are in operation, but maybe the most general point is the war is a significant source of uncertainty, and uncertainty itself is of course, a further drag on economic activity. And in the March staff projections, we published not just the baseline, but adverse and severe scenarios, which capture some of the uncertainty connected to the war. So what I want to do is basically turn to having outlined those three forces, to kind of try and provide some insights by looking at some of the different dimensions of those issues. So as I mentioned, in terms of the kind of recent economic momentum, the pandemic, I think, played a large role in explaining why economic performance in the last quarter of 21 and the first quarter of 22 was pretty low in the euro area. So quarter on quarter, the economy grew by just 0.3 in the last quarter of 21 and just 0.2 in the first quarter of 22. Now, we do think the economy will pick up later this year. And again, a fairly obvious first order issue is the reopening of the economy, especially the services sector. At the same time, exactly when that momentum kicks in fully is still in doubt, because the pandemic, through China, for example, is still contributing to global bottlenecks, while the energy shock and the war are essentially having a current adverse impact on domestic activity. So having recognized the role of momentum from the pandemic reopening, these are significant headwinds for the European economy right now. Okay, so the first chart, which is on the screen, tries to take the perspective of where are we compared to the October 2020 projection from the IMF's World Economic Outlook. The left panel is the world, the right panel is the euro area. So that essentially projected in mid-2020 that not only would there be a big initial hit from the pandemic, but the recovery would be very gradual and very slow. Now by October 21, lighter picture in the World Economic Outlook, because essentially the game changer was the development and rollout of vaccines from late 2020 onwards. So if you go back just 6 months to the October 21 outlook, it both was capturing the fact that 2020-21 was a lot stronger than initially feared, and was also the prospect that 22-23 would be further years of decent economic performance. Now, what we've seen in the April 22 projections is a downgrade. Compared to that more optimistic profile, again, to repeat, the energy shock at a war and the new pandemic waves do mean that the path for GDP now is less bright than 6 months ago. Already, the fact that during 2021, the global recovery was faster than expected, and the combination of that fast recovery with the asymmetric and idiosyncratic nature of the impact of the pandemic across industries and regions does help to explain the range of sectoral demand-supply mismatches that occurred, so bottlenecks, and does help to explain the jump in energy prices. So we understand that in terms of the global picture, that different regions have recovered in different ways. So in the second chart, what I show you is the evolution of domestic demand for the euro area, where I reset to create a useful index, the last quarter of 2019 to be 100. And what I show here is in terms of the private components of domestic demand, whether consumption or investment, we have not returned to the pre-pandemic level, let alone exceeded it. So the one component of domestic demand which is above the pre-pandemic level, which has been true since the mid of 2020, is government absorption, government consumption and government investment. So in terms of understanding the drivers of inflation, the drivers of the recovery, it is not the case that domestic demand has been the lead driver in terms of the overall momentum. Okay, so that's the historical pattern until now. In the next chart, I want to show what the PMI indicators are telling us. So what I show is 3 panels. So the left panel is the assessment of the current situation in manufacturing and services. So the reopening of the economy is supporting the continuing improvement in the services sector. So that's in line with what we would expect. Importantly, we did see a kind of edging down of the manufacturing indicator in March, but it has been broadly stable in April. So it does suggest, in terms of the overall manufacturing sector, so far there's been resilience to the outbreak of the war. However, when you zero in on some more forward-looking components, in the middle panel, we do see a more significant drop for export orders, which have declined more than total orders. So again, the war and the COVID wave in China are already affecting the external sector. And then the right panel shows the expectations component, which fell abruptly for manufacturing in particular. But it's important to also point out it remains in expansionary territory. So I think the fair interpretation is that there is a downward revision in the expectation of how quickly the economy will grow, but not the expectation that Europe is going to go into a recession phase. Let me now turn to the labour market. So at one level, this reinforces the overall message, which is the recovery has been asymmetric. Public sector employment is well above the pre-pandemic level, in line with the previous point that public spending is well above the pre-pandemic level. However, employment in industry and construction are only now approaching the pre-pandemic level, and employment in services is still below the pre-pandemic level. So again, in terms of the how hot is the labour market, it's not the case until now that the labour market has been super hot. Now, it's important also to take into account that the distance which is the right panel here, the distance to the pre-pandemic level is larger for the intensive margin, hours worked per employee, than for the extensive margin, numbers employed. Because of course we know in Europe there was many short-time working schemes, so people remained in employment, but not with full hours. And that remains an issue. So when we see the recovery in the labour market, the hours component is going to be relevant. Now, I don't show it on the chart, but at the aggregate level, the ongoing reduction in the unemployment rate and the recovery in labour force participation do underline that we do have a profile of an improving labour market. Now, I don't have a chart for this, but let me just signal, if you're looking around for real-time indicators of any possible impact of the war, there's a posting yesterday on the Indeed website, which is a collaboration between Indeed and the Central Bank of Ireland, which does show in the Indeed data, which is 21 European countries have Indeed job postings, that there's been an 8 percentage point decline in job postings relative to the trend since the start of the war. Now, the trend is quite positive. There's been a big recovery in job postings, but in terms of looking for a difference in difference indicator, there is a visible shift since the start of the war. So it signals that maybe some employers are holding off on the same trend of job postings as before the war. Okay, so that's some picture is about the real economy, if you like. And again, I'm not trying to be comprehensive in the context of a hopefully short opening remarks. So let me talk now about inflation. So first of all, I want to begin what's already happened. So over the last year, so April 21 to April 22, what we've seen in this chart is I make two charts. So the left chart is just energy prices, which have increased by about 40%. This is a very large increase in energy prices in 1 year. And I'll come back to this chart in a minute, and I'll just go to this chart, which is the chart 6, which basically says, in terms of the volatility of energy prices, this is a very big spike. Compared to what we've seen in recent decades, and even if I go back further than this chart to the 60s and 70s, this spike is much bigger than the spike we've seen in previous episodes, and it's about 4 times bigger than any previous spike during the lifetime of the euro. So in terms of scale, it's important to take into account the scale of what's going on with this. Okay, so it's very important if you're looking at that chart online or in the room, there's different scales here. Because if I try to put the energy inflation on the same scale as all the other categories, it would be nearly off the charts. So it's important to appreciate that when I move to the right panel, I show the overall inflation rate, which is mid sevens. I show inflation rates for the major categories: food, HICP-X, so excluding energy and food, and then goods and services. And one message is over the last year, all of these sectoral inflation rates have been above 2%. But with food inflation above 6 over the last year, in a cumulative sense, the other indicators, being in the ballpark below 4%, but in the threes essentially. So how should we think about the fact that we do have basically above target inflation rates everywhere at this point? So one basic point to make here is the scale of the increase in energy prices means that there's upward pressure on costs across all sectors. Energy is a big input into the production of goods and services. Just think about transportation, think about construction, think about manufacturing, restaurants, food. So there's a when we think about what is the impact of the energy shock, it's not just the direct effect, it's the indirect effect by pushing up costs throughout the economy. Second, going back to my kind of underlying themes here, is that bottlenecks are creating temporary upward pressure on costs, especially if you like for goods and for food. But of course, the nature of bottlenecks is eventually these bottlenecks will be eased. And so these cost pressures would be reversed in the future when extra supply comes on tap. And then third, the lifting of pandemic restrictions can be expected to contribute to temporary price increases in those sectors that are reopening, in view of the kind of pretty big jump in demand between a restricted and an unrestricted sector, and of course the fact that a lot of the labour market and supply conditions in these sectors have been very disruptive during the pandemic. So this is illustrated here. So the left chart shows you trying to work out what's going on in terms of goods inflation, and about 1 percentage point of the currently high inflation in goods can be matched to the contribution of high energy prices and bottlenecks. So again, that's signaling this is not necessarily fully persistent. Those factors in terms of inflation, even if not in terms of price levels, should ease over time. And then the right panel says there's a pretty big correlation between those services sectors which are seeing most of the price increases and those sectors which were contact intensive. So these sectors were very inactive in the pandemic. Not only was spending low, but prices would have been low. but when the economy reopens, there's a reset. And there's a reset of prices. Just think about airfares, hotels, restaurants in recent weeks and months. But again, the reopening is essentially a level effect. Now, what I've argued there is that across the economy, there's essentially 3 adjustment processes: adjusting to higher energy costs, adjusting to bottlenecks, and adjusting to the reopening of the economy. All of those processes are not over. So these adjustment processes, which are contributing to inflation, still have some distance to run, which is also suggested by indicators, essentially, of pipeline pressure. That if you look at earlier stages of production of goods and services, there are price increases that we know over time will be passed along. Now, when we're trying to assess the inflation trend, the persistent component of inflation, it's very important to think about nominal wages. Now, there's good reasons to believe that, having been quite subdued for a long time, the overall recovery in the economy, in the labour market, and the adverse impact of unexpected inflation on real wages should lead to faster wage increases over time. So let me differentiate there between 2 different components. One is, it can be interpreted as, again, another adjustment mechanism to these forces which have led to high inflation in the last year. But when that adjustment is over, it doesn't necessarily mean that wage inflation is going to permanently pick up. So it's important to look at that component, but also look at the alternative or additional mechanism, which is if the phase of high inflation permanently resets inflation expectations, you may also have a longer term change in inflation dynamics, even after the adjustment is over. So let me turn to the next slide. And what this slide tries to do in a compressed way is show you essentially the evolution of wages so far, and that's in line with the data coming in that's been a very moderate increase in nominal wages. But then what I also include here is an experimental wage tracker developed by the ECB. And the wage tracker basically projects forward because we know the information that's contained in wage agreements that cover this year and cover next year. So even if the wage increase has not yet happened, if it's in the wage contract, you know it's going to happen. So the dotted line looks at the aggregate. Some contracts were signed many months ago, but they do cover 22 and 23. And the aggregate basically shows a sidelines profile, continuing a fairly moderate increase in wages. What I show in the green bars is if I just zero in on the most recently concluded wage agreements. So those wage agreements that were concluded this year in 22. So inflation had already picked up before these wage agreements were completed. And what we see here is that for 22, those wage agreements are around 3% increases for 22 and around 2.5% for 23. So significantly above the average. So if you think the marginal wage agreement is a better guide to, if you like, what can be expected in the future, this is maybe a more useful indicator of the contribution of wages to underlying inflation pressures. And just to recall, nominal wages growing around 3% is more or less in line with a 2% inflation target once you allow for labour productivity growth, which might be ballpark around 1%. Let me make a second point here, which is essentially what we're seeing is a front loading. So if these wage agreements are giving a bigger wage increase for 22 than for 23, that's consistent with basically a degree of catch-up, a kind of temporarily high wage increase this year in recognition of the unexpected inflation that's already happened. But the fact that there's a kind of front loading does also suggest that those party to wage agreements don't think the inflation increase is permanent. They think the inflation will decline over time, at least as revealed by those wage settlements. Okay, so I think that's an important indicator. Let me now turn to the momentum in inflation dynamics, because of course the convention is when we hear the monthly inflation number, it's comparing April 22 to April 21. In May, it's going to compare May 22 to May 21. Most of that has already happened. So in terms of momentum, it's obviously going to be a slow-moving indicator. So the fact that the price level has jumped already will continue to feed high inflation readings for a while. So sometimes it's useful to zero in on momentum. And momentum here is basically what I have here is the left panel. So it's two panels. One on the left is for headline. The one on the right is for core. The left panel, the blue, is what's already happened, and here now it's easier to use quarterly data than monthly data. So it's the inflation rate from the second quarter of 21 to the first quarter of 22. So over that 12-month period, the price level jumped by over 6%. If I use the survey of monetary analysts, which you can find on the ECB website, in terms of the price level increase expected between quarter 2 22 and quarter 1 23, it's projected to remain above target at 3 point something. But then after that, the projection is that inflation will be found a little bit below the 2% target. So what does that mean? It means there's one more year in expectation of momentum in inflation being above target. And after that, the inflation dynamic will be around 2%. And remember, monetary policy, of course, operates on inflation momentum. We cannot retrospectively alter the price level increase that's already happened, but monetary policy will operate on momentum, especially further out. So essentially, it's a very big issue. Is a lot of the high inflation reflecting the surprise increase in recent months versus how much is already or is expected to be maintained. And essentially, we have this transitory period for next year where there's a pipeline. There's still all of those adjustment processes. Wages have not adjusted. Bottlenecks are still with us. There's still incomplete adjustment to the pandemic and to the war and to oil prices. Okay, so that's essentially looking at the next couple of years. We think longer-term inflation expectations are relevant for lots of reasons. So what I want to do is go through some of those results. So here in this chart 10, what I show is the survey professional forecasters. And I show three vintages. The blue line is the distribution of results from early 2021. And that distribution was pretty stable for a long time until that point. And what I had was that basically the mode being around 1.6 and most of the distribution being either to the left or, if anything, well below 2%. So there were not many professional forecasters at the start of last year expecting either the ECB to hit its target or fearing above target inflation in the longer term. Over the course of last year until the start of this year, there was a re-anchoring of this survey at our 2% target. So the mode moved to 2%, and yes, there's more of the distribution to the left than to the right of the target, but there was a lot of progress in re-anchoring expectations at 2%. And then maybe what's interesting is in the most recent survey in the second quarter, it's the mode is more or less the same, but if you look at that chart, what you see is a movement to the right. In particular, the number of respondents fearing inflation above 2.5 in the longer term has moved up. So there's an increase in dispersion in terms of the right tail, and that's something that various people would speculate on in terms of the role of dispersion in inflation expectations. Okay, so let me move to the market-based measures. And so the market-based measures, on the left side, I show the 5-year, and the right side is basically a sequence of 1-year expectations. Inflation for 1 year, 1 year from now, for 1 year, 2 years from now, etc. And what I show is basically the raw data and then the effort by ECB analysts to strip the raw data from risk premia. And I think if I look at the left, which is the time series evolution of the 5-year, is what you see is again a pretty strong re-anchoring of their expectation, the yellow line, from around 1.6 in 2020 to basically just below 2% now. So again, there's a consistent message between the market-based measures and the survey-based measures of essentially the most likely outcome being around our 2% target. But it's important to emphasize is that the risk distribution has moved. That for essentially a long time there was an inflation risk discount. People were not fearful that inflation would be high. They were not willing to pay a high price to obtain insurance against high inflation. Whereas more recently, there's been a big increase. So there's a big increase in the inflation risk premium. So again, it's not necessarily that the world is expecting that the most likely outcome will be inflation above our target, but they want to buy insurance against that risk. Okay, so that's the market-based measure. So the next measure is coming from an ECB survey which has mostly been used internally. There's been some now new research published upon it. But for policy purposes, one important question for us is the evolution of household expectations. And what this graph shows you is whether you look at the mean or the median, essentially over the course of this survey over the last, since the start of 21, it was very stable until the most recent report in March. In the most recent report in March, there's been a marked increase in the median and mean inflation expectations 3 years ahead of European households. Now, of course, there's huge dispersion around that. And so the right panel captures what's going on. So the right panel compares the February survey to the March survey. So what's happening is there's still plenty of people who think 3 years from now, what's that, something like a quarter either think inflation will be 0 or negative. So there's always going to be dispersion. But the big movement, it's not the case there's been a big rotation from people believing inflation will be 2 to believing inflation will be 3. So it's not like the survey professional forecasters where there's kind of minor revisions by individual forecasters within a narrow range. What is true is the proportion of people who fear inflation well above 4% has gone up. Now again, we know from the literature on household expectations that the level is maybe not something to overly focus on because it's not to be expected that households are experts on the intricacies of central banking. But the change is relevant. So if there's a significant change in expectations, it's something that warrants close monitoring. Okay, so maybe I'll just finish by talk about monetary policy. So it's important when we talk about monetary policy to recognise that in recent years, the monetary stance of the ECB has been a combination of different measures. The low level of the key policy rates, rate forward guidance, which is intended to essentially manage the yield curve at the mid-range, asset purchases, which we think manages the yield curve at the long end, and then targeted lending operations, which provides low-cost funding through bank lending. So essentially, in recent weeks and months, there's been quite a lot going on, even if, of course, the policy rates have not changed. So the period of very low interest rates on the targeted lending comes to an end next month. That's one element of normalization. As I show here in chart 13, which adds up APP and PEP, there's been a very substantial reduction in the rate of monthly purchasing. So this is drawn through June, which will, it's going to continue to decline to June to 20 a month in June. But you can see in terms of the kind of impulse, in terms of the addition to our stock, that there's a very significant decline in the rate of asset purchasing over these months. And of course, we've expressed our expectation that this will end in the third quarter. Now, for many purposes, in terms of thinking, okay, what is the stance of monetary policy? It's relevant to look at the yield curve. And until fairly recently, a lot of time and discussion would have been on comparing the three lower lines, which is the yield curve. The yellow line is December 21. The green line is December 19th, so pre-pandemic, and the red line is December 20. So essentially the pandemic, essentially, when you look at it, you say, okay, there's essentially a policy to stabilize the yield curve. In the grand scheme of things, the yield curve was stabilized in those periods. Of course, there's a lot of discussion and policy debate about moving the yield curve from the green line in December 19 to the red line in December 20, and then tolerating the movement in 2021 from the red line to the yellow line. But when you start to think about the scale of this, that's all fairly minor compared to the resetting of the yield curve this year. So the latest yield curve looks quite different to all of those yield curves. So again, in terms of the contribution of asset purchasing at the long end and the contribution of rate forward guidance, where the market understands the closer we are to fulfilling the rate forward guidance criteria and the more the medium term outlook resembles our target, the more likely is normalization. Now, of course, the particular path for the market yield curve also prices in risk premia, so it's not a kind of true expectation of the actual policy path. So that's very important to say, is that yes, the policy rates have not moved, but a lot has moved in terms of endogenous monetary policy responses. Now, when we think about the normalization process, let me just make a couple of small remarks. One is that gradualism is an important consideration. So while the normalization process should ultimately result in policy rates reaching the level that maintains inflation at 2% on a durable basis in steady state, so the so-called neutral rate, the timeline to complete this normalization process is intrinsically uncertain for two basic reasons. First, there's a feedback loop. It's important to take the time to observe the impact of shifts in financing conditions on inflation dynamics. So there's a wide range of estimates of the impact of higher interest rates on activity levels and inflation pressures. In particular, we have to take into account there are significant interaction effects between shifts in financing conditions and other macroeconomic forces. Decisions to lend and to borrow, of course, look at the interest rate, but they look at the wider macro context. And so incorporating this feedback loop, the need to learn about the size of that effect under current conditions needs to be incorporated into the monetary policy decision process. Now, in particular, as we move along the normalization path, both the benchmark market interest rates and the lending margins will adjust. So again, whether that's lending margins in bank lending, or we can also think about spreads in corporate bonds. And so while there's a lot of empirical evidence on the elasticity of benchmark rates to the gradual reduction and termination of net purchases, the reaction of loan pricing policies of banks and also the resetting of the terms and conditions of lending to policy normalization is not so easily forecasted. And as I say, it's multifactorial in terms of its determinants. And in turn, at a second level, the impact of any increase in interest rates and tightening of credit conditions on economic activity and on the formation of inflation expectations are also subject to considerable uncertainty. So that's, if you like, a model risk, if you like, it's working at the correct calibration. And then second, the high uncertainty about the economic impact of the war in Ukraine, uncertainty about the energy shock, and the uncertainty about the post-pandemic recovery, not just in Europe, but around the world, means that it is unlikely that the economy will quickly settle into a new steady state neutral equilibrium. So if we don't know when we're going to be at neutral, it follows that cyclical factors are likely to remain important for the course of monetary policy. So there's an underlying normalization trend and an overlay of cyclical considerations. And so for these reasons, our policy decisions will remain data dependent and reflect our evolving assessment of the outlook. And our overriding commitment is to make sure that our policies will fulfill our price stability mandate. And in particular, we stand ready to adjust all of our instruments within our mandate, incorporating flexibility if warranted, to ensure that inflation stabilises at 2% over the medium term. So with that, Maria, I'll see what questions you and Slido have for me.
Absolutely. Thank you so much, Philip. It's really absolutely essential that we look at the numbers at that level of granularity, and thank you so much for presenting that. Some of the questions, of course, are very anticipated. I'm sure you will agree in a minute. I remind our audience that you can ask in Slido with the hashtag Euro. I'm monitoring the questions. And of course, I would also like to invite our colleagues here to ask questions. So I will come back to you. Let me give first the obvious questions to Philip. I'm sure you'll anticipate them. The first question is about the policy rate, what happens next. I mean, I'm sure you understand that a lot of the questions that are coming in are focusing primarily on the July meeting and whether this is the time to hike interest rates up. This is a summary of a number of people that are asking. To that, if I may add a slightly related question and actually raise the issue of the appropriateness of monetary policy as we're going forward, given the risks and the uncertainties that we're facing. There is, it's interesting, your wage tracker, that it's a very interesting measure actually to try and sort of understand a little bit, get sense of the second round effects. I've noticed that Belgium is not part of your wage tracking. Belgium has got, as we know, we have implemented 4 times 2% increases. There are 2 more announced for 2023. Your wage tracker will look very different if you had Belgium in there. But of course, Belgium is a small component of the euro area. We measured yesterday the dispersion of inflation rates in the euro area, cross-sectional, number of countries. It was about 1% 2 years ago. It is now 3% on HICP, which means that the variations, the divergences of inflation rates in the euro area are increasing. There has a lot of reasons why this may happen, a lot to do with energy, of course. But the fact remains that the euro area, the eurozone, has got an increase in divergences when it comes to inflation, and not only. So that's our first question is, the obvious one, what can you share with us in terms of the policy rate and, of course, the appropriateness of monetary policy as we're going forward?
Okay, so let me try and put this into context, and I think I invite you to jump forward and retrospectively look at 2022. I think that's a useful way to think about it is, I think that there's, again, you've mentioned the uncertainty, and it's important that we don't actually make decisions until we make decisions, because who knows what the coming weeks will bring in terms of the war in particular. I mean, other dimensions of data might be on fairly predictable pathways, but the war is not so easy to predict. But again, with that kind of perspective, is that I think what I've tried to show you today is that we don't think we're going back to the pre-pandemic, pretty sticky equilibrium where inflation was persistently below our target. And so we do, if you like, maybe by opportunistic, that this inflation is I think very costly for many people. But if it sets resets medium-term expectations at 2%, it does mean the policies we've had for a long time, low policy rates, QE and so on, should not be maintained. So there is a normalization, and I've said to you there's a sequence here. A lot has already happened in terms of the asset purchases. A lot has already been anticipated because with our forward guidance, we mean it. We mean it that once we think inflation is projected to be durably set to be around 2 and we see enough progress in underlying inflation, we will raise rates. So then you get to the much more kind of a limited question about when exactly does that start. And I'm not going to add to the discussion on that because it should not be seen as the most important issue. Because, and honestly, I mean, there's been a lot of, because interest rates have been at this level for so long, of course it's interesting to know when will interest rates move. More consequential. And once we do start moving, like every other central bank, once you start moving, the whole conversation, okay, how much are you going to do and how quickly? So it's the whole future path of interest rates. So I think the debate about which exact meeting is the best meeting to make the first decision, let's see. But honestly, the bigger issue now for monetary policy is to work out, okay, what path. And again, what I've tried to emphasize in this speech is, even if it's fairly easy to say, so let's be clear, minus 0.5 is not in line with the 2% inflation target. If we believe inflation is going to be stable around 2, minus 0.5 is not consistent, 0 is not consistent. We know normalization is going to be more than that. But what I've also said is normalization or the trend is not the only issue. We also have various cyclical shocks that will determine the speed and the pace of normalization. And I've also emphasized the feedback loop. You have to learn from, because already, and we are seeing lending conditions change. This doesn't happen in a jump overnight, but now, because we've had a good number of weeks of the yield curve having moved up, it is moving into lending rates now and into terms and conditions. So we also have to observe this, saying, okay, in order to maintain the inflation momentum of 2%, the speed will depend on learning from that. It's going to depend on the world economy. It's going to depend on the war. So there's a lot of unknowns in terms of determining the exact path we take. But in terms of the overall orientation, I think it's clear that at some point we're going to be moving rates, not just once, but over time in a sequence. And the second issue, it's very important on inflation differentials, is that we had, at this point, 14, 15 years ago, significant interest rate differentials, which could be linked in a causal way to very difficult imbalances. So whether current account imbalances, differential credit growth. So it's basically a big signal that there was a lot of policy differentials across Europe, and in turn a lot of those policies would be pretty difficult to turn around. So switching off a credit boom, switching off excessive fiscal expansion and so on. What we have now is big inflation differentials, but it's not so obvious that these are going to be, because partly there are different income levels in Europe, so the role of energy and food as a share of the price level differs across countries. There's different policies about how quickly wholesale prices for energy get passed through to retail prices, but that's a timing issue. Eventually, a lot of countries will have to absorb fairly similar energy price increases. So, as of now, it definitely will affect spending patterns, income patterns across the member countries month by month at the moment. But in terms of the kind of policy message, it's quite different compared to the persistent differentials we had all those years ago.
Thank you, Philip. Maybe if you have the time, I try and group questions. I will take two Bruegel questions, one from Zsolt Darvas and one from Gregory. I will read it after Zsolt has given us his question.
Thank you. Thank you very much for this very insightful presentation.
We can't hear you.
Can you hear me?
No. No, it's on, yeah.
So can you hear? Yeah. So thank you very much for this very insightful presentation. So let me ask two short questions. The first one is the reliability of inflation expectations. I mean, in your presentation, you showed that both the survey of professional forecasters and also market-based expectations are still, at least in the long term, show values around 2. And it seemed to me that you take some comfort from that in the long term. Yet if you look at these expectations in the 5-year period before the pandemic, let's say from 2014 to 2019, they were, I mean, very unreliable in a sense that inflation very significantly undershoot by expectations. You know, they were drifting down a little bit, but clearly I think this major inflation undershooting was not foreseen by anyone. So do you agree that these expectations are not very reliable? And if so, what to conclude from that? And the second question is a scenario of the war, which, for example, we cannot exclude that one way or another Russian gas will stop flowing into the European Union, which would imply an even higher inflation and also possibly an economic contraction, because in some countries, including Germany, is very much dependent on Russian gas. And if there will sudden stop in gas flows, then Europe would face a period of even higher inflation with falling economic activity. So what would be the principles for monetary policy making under such a scenario? Thank you.
Thank you a lot. We'll take also from Stavros one question. Stavros Zenios, also from Bruegel, and then the one from Gregory. Stavros? Yes, please. Yeah, because we can't hear you otherwise. Yeah.
Yeah, okay, good,
Yeah.
great. Thank you very much. It's very nice to see this detailed analysis of the data, but for a very complex issue, and there are two channels that I would like to understand a little bit better. One is about the unemployment that you mentioned after the pandemic, how it recovered quite well for the public sector, but in general, it has not reached up the pre-pandemic levels. Now, if that indicates a sluggish demand, that's one implication for inflation. But if that is a result of a phenomenon like we've seen in the US of the Great Resignation, the implications are different. So can you say something about what's the underlying? Do we see in Europe also a Great Resignation phenomenon? People are not willing to come back. And the second relates also to Zsolt's question. If a big impact on inflation is the energy cost, doesn't that make your job very difficult? Does it make sense to try to fight inflation with interest rates when the inflation is coming from a very specific variable, which also has an adverse effect on growth? I mean, you have this difficulty of balancing growth and inflation, and now the major shock is working against you, if that's the case, if energy seems to be the main thing. So thank you very much.
Yeah, thank you very much, Stavros. And with that, I will also add the fragmentation question coming from Gregory Claes, and I'm going to read it for you, which is, would PEPP reinvestments be high enough? I have seen, he says, that they should represent around 400 billion euros in the 12 months to counter euro area fragmentation risks if needed. Philip, 3 very comprehensive questions and extensive.
Okay, so it's the issue about expectations is very interesting. So maybe, and it's a debate around the world. Let me just say, it shows the value of basically comparing some pretty basic differences between the US, the euro area and Japan, but also differences within Europe between us, UK, Sweden and so on. It is absolutely the anchoring the role of inflation expectations plays an important role. Let me zoom in on the euro area. I mean, in those years before the pandemic, what we essentially were seeing is that inflation, for example, was persistently coming in below, for example, the Phillips curve. Now, this is labelled a negative residual, but the way to reconcile that with any theory was basically people no longer believed inflation would be around 2. So wage setters, targeting a particular real wage outcome, there is always going to be a self-fulfilling aspect. If you believe inflation will be around 1, and you assume productivity growth of 1, you ask for a nominal wage increase of 2, all else equal. If you expect inflation to be 2, you ask for a nominal wage increase of 3. This is not just a kind of a theoretical observation. Look at the difference in countries with similar enough labour markets but very different inflation outcomes. The only way to reconcile that is there is a self-fulfilling pattern to inflation which has to be labelled essentially this expected inflation component. It's not, I'm not saying that, so they might be okay conditional forecasts, but I'm fully signed up to the world that there's lots of shocks happen. So the outcome may be dominated by the variance part rather than the conditional part. So I'm not saying, but in terms of behavior and the inflation dynamic, it is very important, which connects to the role of energy costs. So yes, we don't, it's by and large, the textbook does say the energy costs should be looked through. But the exception is if it's big enough and long enough that it basically alters inflation expectations. And again, and what I showed you, I spent time on showing there has been movements in inflation expectations. I'm also sympathetic, and we in the strategy review, and by the way in central banking in general, have basically said, look, let's also see it. Do we see it? Because just asking a survey, is it changing behavior? So do we see it in behavior? And in behavior, we are starting, the wages going up now, I think is consistent with the fact that it is altering wage behavior. And so this is why I do think underlying inflation is picking up. Okay, so war. We put out, or the staff who do the work in March put out 2 war scenarios. Now again, these are not meant to be tail risks. They're just, here's 2 possible scenarios. And what was interesting about these scenarios is in one scenario, it was essentially assumed that there would be a kind of a second round effect. So that the further amplification of the energy cost would also lead to faster wage increases. And if you like, inflation over the next few years being higher for that reason. And if it's medium-term inflation, that have a monetary policy implication. The other scenario, basically more worried about the fact that a very big recession would increase slack in the economy, reduce the bargaining power of workers, and lead to less inflation. So the 2 scenarios, one scenario has more inflation than the baseline, the other has less inflation than the baseline in the medium term, which is basically an empirical matter. Would these scenarios lead to kind of very strong wage dynamics, or would the gloom of an overall recession essentially refocus workers, if you like, on maintaining employment rather than looking for wage increases? You can build those scenarios, and that's where being data dependent and looking at that would be important. So what the sequence I showed you was, I showed you that expenditure levels, apart from the public sector, are still subdued in Europe. I've quite often presentations shown that side by side with the American example, where expenditure levels, because of the scale of the fiscal subsidies were so big, went well above the pre-pandemic level. So in the European context, we have not had very high demand, and in turn that means that there has not been this very volatile labour market. And as you know, there's a much more of a intensity of maintaining people in employment in Europe as opposed to in the European situation. So as far as I know, the Great Resignation is much more muted in Europe. It's maybe exaggerated in America as well. Of course, there's big lifestyle changes. We all working from home, all of these things, but there isn't, I think, a kind of macro level issue there. What we've said is on fragmentation is it's a general commitment. We've said one mechanism by which any fragmentation pressure could be addressed is through flexibility and PEP reinvestment. But the final sentence in what I said, which is the same as the final sentence in the monetary policy statement, and which was elaborated in the speech by President Lagarde at the ECB Watchers Conference, was basically there's a general commitment to avoiding fragmentation, and that can be executed or implemented through a range of instruments. By the way, there's a general comment I often make about this, is we have a very simple mandate. The instruments we have in the European Treaty are very general. So overly worrying about what particular instrument to use for what particular task is a little bit of a second order issue, because we have a very simple mandate, and we know that flexibility in monetary policy within our mandate and when warranted is important. And I much more focused on that general commitment than the details of what any particular instrument might do. So I'm sympathetic that people, in particular segments of the market, are curious about fine details, but the fine details are a secondary issue.
Thank you, Philip. We are already 2 minutes over time, but if I may have one final thought because there is a number of questions that, if I could bundle them together, would be about the risks. And thank you for actually taking us through the two scenarios you had in your forecast, which I think are very interesting to understand how you view risks. There's a number of people who would like you to give us an oil price forecast, which I think is a very difficult thing to do. But if I may just, and here with that I would like to finish and hear your thoughts. You come to Brussels on the day after the European Commission has announced that we will have, we will decouple from Russia when it comes to oil. Now, how quickly we do that, of course, remains to be seen, and with what exceptions. But the fact of the matter remains that as we decouple from Russia, at least in the very short term, or if dare I say the next 6 months or so, the price of oil will necessarily go up. So your graph that you showed on the energy side will necessarily get much worse, which of course then adds to all the conversations about the contribution to inflation and also the persistence of inflation. So is it fair to say that things will have to get much worse before they can get better?
So I think it's important for our role here is essentially to be acknowledge the uncertainty and to be very data dependent. So conditional, so it's a very conditional statement, Maria. So, okay, conditional on various restrictions on importing oil from Russia. You might condition on that, surely there's a price impact. But what we've seen in recent weeks also is globally there's been a significant decline in the price of oil, which you might attribute, for example, to the lockdowns in China, so the energy demand from China being low. I'm sure there's a seasonality. Here we are coming into the northern hemisphere summer and so on. So there's all sorts of dimensions about what's going to be the net driver of oil prices and so on in any particular window. So I think we would recognise energy prices are highly volatile. It's important not just to look at the latest twist and turn, but the overall dynamic. But we I think are fully participating as a European institution in the whole effort of the European Union collectively, to support Ukraine, in this situation in all sorts of ways. We had I think we were publicising yesterday, joined by the governor of the Ukrainian central bank with us in Frankfurt yesterday to have in-depth discussions of a lot of what's going on, and so it's a two-track issue. Practically, ECB is doing a lot to support the implementation of the European policies, but then in terms of the macro outlook, we have to recognise, I think the most important comment is uncertainty and data dependence.
Thank you very much, Philip, for taking the time to come to Bruegel to tell us your thoughts and explain the data. This is extremely useful for us, and we all hope and that this war will end soon, and we can go into a true normalization. But with that, again, thank you so much for coming today, and thank you, our audience, for participating, for all your questions. We are very grateful. Thank you.
Thank you.